Welcome back to the Deep Dive. Today, we are tearing through a stack of sources that tell an astonishing, almost, well, unbelievable story.
Astonishing really is the only word for it.
We're talking about the historic, jaw-dropping performance of gold in 2025. This wasn't just a good year for precious metals.
No, not at all. It was, I think, a fundamental re-rating of what global asset stability even means.
If you were tracking the market, you saw gold shatter over 50 all-time highs.
Throughout the year, yeah. Posting approximately 60% returns in US dollar terms, that kind of movement it's truly rare.
60%. I mean, that performance didn't just beat. It absolutely outperformed virtually every major asset class we tracked.
Right. Equities, fixed income, commodities, cash.
We're not talking about a modest bump. We are looking at a monumental rally that drove the price comfortably past $4,000 an ounce.
And our mission in this deep dive is really to shortcut you past the simple headlines. We've pulled analysis from the World Gold Council, JP Morgan, Saxo Bank.
And they all point to something bigger.
They do. The sources clarify one thing immediately. This surge wasn't due to a single isolated event. It wasn't just a minor inflation scare.
It was a perfect storm.
A perfect storm is a great way to put it. It was this complex interaction of geopolitical tension, major shifts in central bank strategy, and some very deep dollar dynamics. That's how we got here.
Okay, let's unpack this 60% return. That demands a detailed explanation. What exactly fueled this monumental movement?
The sources show it was a powerful convergence of cyclical opportunities and, I think, structural anxiety,
Right.
meaning you had high-risk premiums baked into the price, reflecting immense global uncertainty.
Okay.
And at the same time, you had this powerful market momentum from very dedicated buyers.
So let's start with just the sheer scale of the climb. Gold comfortably surpassed $4,000 an ounce by the end of 2025.
And to really grasp that acceleration,
Well,
the sources point to a massive 16% increase just in the third quarter alone.
16% in one quarter. And that was driven by, what, record investor demand?
Record frantic investor demand. And this is where we have to move beyond the simple narratives. For the listener who wants that thorough explanation, the World Gold Council's models attribute the returns to multiple factors at once.
Right, you can't just point to one thing.
Exactly. You're talking about the convergence of economic growth, risk premiums, uncertainty, opportunity costs, and momentum.
That's a lot of competing variables.
It is. But that convergence is what makes this rally feel structural, not speculative. Gold wasn't just reacting to interest rates anymore.
It was doing multiple jobs at once.
Perfectly put. It was a safe haven against geopolitical risk, a store of value against fiscal instability, and a momentum trade. What's fascinating here is the convergence of cyclical and structural elements. Gold was pushed beyond its traditional role as just an inflation hedge.
The market started seeing it as a necessary risk management tool.
A necessary tool against systemic global instability, yes.
So, if it wasn't just about inflation, let's look at those systemic drivers. The sources say the foundation for this whole rally came from state actors.
That's right.
Let's dive into that central bank demand.
This is the most important long-term factor. It's the floor under that $4,000 price. Central bank purchases hit 634 tons in just the first 3 quarters of 2025.
And for context,
That volume significantly exceeds the average annual pace we saw in the entire decade before 2022. It signals a lasting change.
and who are the key players here? Are we talking about the U.S. Fed or the ECB?
Not primarily, no. It's the emerging market central banks spearheading this diversification. They acquired 220 tons in Q3 alone.
Wow.
That's a pace 10% above the previous year. And this is a robust strategy. We saw data that banks like Poland's National Bank kept buying heavily, even as the price shot up.
So they weren't deterred by the high price. They saw it as a necessary long-term strategic move.
Exactly. Which brings us to the core concept here.
De-dollarization.
De-dollarization. We see nations actively and sometimes aggressively moving reserves away from dollar-denominated assets. This is the big structural shift.
So why the sudden coordinated rush away from the world's reserve currency?
The central reason cited across all the research, especially JP Morgan's, is the heightened risk from U.S. sanctions and these growing geopolitical divides.
Right.
So if we connect this to the bigger picture, this sustained reserve diversification is a clear response to the growing politicization of global payment systems.
And when you say politicization of payment systems, what does that actually mean for a country holding reserves?
It means vulnerability. I mean, reserves used to be just about financial stability. Now they're also a geopolitical weapon.
Right, a tool.
A tool, yes. So when a nation sees assets being frozen, seized, or access to SWIFT being restricted, they realize their dollar holdings come with a huge counterparty risk. Gold has no counterparty risk. It becomes essential.
So it's a self-preservation measure. And the sources point out that BRICS countries are really prioritizing this monetary independence.
Absolutely. They added a collective 166 tons in Q2 alone to push this agenda. But we have to clarify a nuance here that JP Morgan highlights. Okay.
This isn't an abrupt apocalyptic flight from the dollar. It's framed as a measured diversification within broader dollar portfolios.
That is a crucial distinction.
It is. It's about making incremental adjustments to reduce exposure to U.S. legal reach, not about, overthrowing the entire currency system overnight.
So central banks built the strategic floor. But what accelerated the climb so fast in the second half of the year? That has to be private investors.
The demand from the private side absolutely poured fuel on the fire. Exchange-traded funds, ETFs, saw staggering 134% year-over-year growth.
134%.
They accumulated 537 tons in just 9 months. To put that in accessible terms, that's an annualized inflow of nearly $108 billion.
So institutions and retail investors were all making a serious, urgent portfolio reallocation.
They were looking for alternatives to assets they suddenly saw as less reliable. The research specifically calls out a massive shift away from bonds. And that's interesting, because gold usually struggles when yields go up.
Normally, yes. But this time, the massive demand from Asia and the official sector just completely canceled out that typical downward pressure. It was so resilient that Saxo Bank openly called it a potential regime shift.
A regime shift.
A regime shift in how the market values gold. They realized it was no longer just trading on inflation expectations.
So that systemic instability is driven by pressures on fiat currencies themselves.
Yes.
We've seen the strain from normalized deficits, fiscal dominance, and just, political influence creeping into monetary policy.
And those factors are crucial because they directly impact policy credibility. Let's just define that term quickly. Fiscal dominance.
Please.
It happens when a government's huge debt and spending pressures basically dictate what the central bank does.
So the central bank is forced to keep rates low or print money to finance the deficit.
Right, which compromises its main job of keeping prices stable. For you, the listener, this means elevated debt levels challenge the ability of policymakers to manage the economy without causing a lot more pain.
So when faith in the central bank's independence wanes, confidence in the currency itself is challenged.
Precisely. And then geopolitical factors, like sanctions risk, embed these deep, long-term risks into the system. This whole context caused gold to be repositioned.
As more than just an inflation hedge.
As an institutional credibility buffer.
I like that framing. An institutional credibility buffer. The price is high because the buyers are structural, not just chasing a quick profit.
Exactly. JP Morgan's analysis supports that. This sustained demand, made worse by stagflation concerns, is what underpins this high price. Investors believe this painful mix of low growth and high inflation is here to stay.
So 2025 was the year the record books were smashed. Let's turn to 2026. What does the outlook look like now?
It's nuanced.
The research notes that despite the rally, gold's allocation in global portfolios is still pretty modest, which suggests there's still headroom.
There is. But the sources give us conflicting forecasts, which is valuable. On one hand, the World Gold Council projects range-bound trading for much of the year.
Okay, so stabilization.
A stabilization, especially if economic growth holds up and geopolitical pressures ease a bit. They caution we could see corrections of 5 to 20%, mostly tied to profit-taking from those ETFs.
Yeah, that's the cautious view.
That's the cautious view. But then you have firms like JP Morgan taking a much more bullish stance. They're anticipating averages near $5,055 an ounce by late 2026.
Whoa.
Yeah. Their forecast is fueled by expected global rate cuts and the absolute expectation of continued nonstop central bank buying.
Here's where it gets really interesting. We have cautious stability from one group and a confident push toward $5,000 from another.
Right.
How do we reconcile those? What makes JP Morgan so much more bullish?
Well, JP Morgan is betting that the structural support from central banks is strong enough to weather any temporary economic calm.
And they assume rate cuts are coming.
And they assume the Fed will cut rates, which is a powerful traditional driver. The WGC projection, on the other hand, is more weighted toward how private investors, especially in the ETF market, will react if recession risks fade.
So if the world feels less volatile, private money might rotate back into riskier assets.
Exactly, causing a temporary dip.
So what are the key risks that could derail that higher $5,000 projection?
The two major risks cited are reflation. So a quick return of high inflation plus strong growth, or ironically, unexpected dollar strength.
Dollar strength.
Yeah, driven by global capital flight back into the U.S. economy. If either of those happens, it could erode the massive risk premiums that built up in 2025.
This has been a dense but absolutely essential deep dive. Let's synthesize the two biggest takeaways for you, the listener. First, gold's 2025 advance was not a speculative fluke.
Not at all. It integrated both cyclical market forces and major structural shifts, confirming that those multi-factor models are the best way to understand its movement.
And second, central bank acquisitions are providing a crucial, durable foundation amid these ongoing de-dollarization efforts.
And as market participants, you have to continue to track those ETF flows and global policy developments. Remember, historical patterns show volatility can return even within a strong upward trend. The structural story is sound, but the daily price action will remain choppy.
A story of geopolitical risk permanently changing the asset landscape.
It really is. Now, for a final thought for you to mull over. Given that the core dynamic of reserve diversification persists no matter the near-term price, whether it's 4,000 or 5,000, consider how future geopolitical flashpoints might accelerate those adjustments even further. Could this sustained incremental state buying be setting a permanently higher floor for gold prices, fundamentally divorcing its value from traditional interest rate dynamics? That's something to think about.